Brookdale Senior Living, ticker BKD, just dropped their Q2 2026 earnings, and we are looking at a massive bottom line beat. They posted GAAP earnings per share of 10 cents, which completely obliterated the Wall Street consensus estimate of a 6-cent loss.
Right, so that is a 16-cent beat, which marks a 266% positive surprise. I mean, it's a really sharp swing from the 18-cent loss they reported this exact time last year.
But the top line missed. Revenue came in at $718.6 million, falling short of the $732.7 million consensus by nearly 2%, and that drops 11.6% year over year. As for guidance, management strictly reaffirmed.
Yeah, they maintained their full-year 2026 adjusted EBITDA target of $502 million to $516 million, and they kept their rev-by-air revenue per available room growth target pegged at 8 to 9%.
And the stock reaction was just a highly volatile, brutal sell-the-news event. Shares closed the regular session at $13.69, saw this brief pop to $13.91 on the EPS beat, and then sank 4.57% after hours to $13.65.
And the sell-off didn't even stop there. The next day, the stock got pushed down over 8% to $12.55 before it finally caught an institutional bid.
So we are pulling all of this data from Brookdale's Q2 earnings call, their latest supplemental presentation, and a handful of fresh industry analyst notes. And the mission for this deep dive is for you to really understand this massive disconnect.
Yeah, between a double-digit revenue drop and a triple-digit profit beat. We have to figure out if this post-earnings sell-off is, a fatal warning sign for the company, or if it's just a massive overreaction by a market that is fundamentally misinterpreting the strategy.
Because if you are holding the stock or looking at the senior housing sector, that divergence is the absolute crux of the issue. The market brutally punished a company that just delivered a massive profit beat. Why did institutions look past that 10-cent EPS and dump the stock?
It basically boils down to three specific data points that institutions locked onto, completely overshadowing the bottom line. First is that top-line revenue miss we just mentioned. Second is management's own admission on the earnings call that their first-half occupancy growth came in, well, slower than they had internally modeled.
Right. And third is the reaffirmed guidance.
Exactly. When a company posts a surprise profit but refuses to raise their forward guidance, the market starts reading between the lines. It suggests a lack of management confidence in the back half of the year.
It turns a momentum story into a show-me story.
100%.
Let's unpack the actual mechanics of that revenue miss, though, because this is where the numbers seem to completely contradict each other. We're looking at an 11.6% drop in overall revenue, with resident fees down 8.7%, yet their profit metrics expanded.
Yeah, it's wild.
How do you generate more profit by bringing in less money? It looks like a company trying to lose weight by just cutting off an arm.
Well, that aggressive portfolio optimization is like the entire thesis of what management is attempting here. That double-digit revenue drop was not a result of residents suddenly fleeing their core flagship properties.
Okay.
It was driven almost entirely by the fact that Brookdale intentionally shed 15.7% of their consolidated average units.
Wait, really? They got rid of nearly 16% of their physical capacity.
Yeah, through community dispositions and lease terminations, they are purposely shrinking the total footprint of the company to grow more profitable.
So they're essentially deciding to stop operating certain buildings altogether.
They're looking at the bottom decile of their portfolio. The buildings that are, chronic underperformers, the ones located in bad demographic markets, or ones trapped in highly unfavorable lease structures, and they were just cutting them loose.
Wow.
When you terminate a lease on a struggling 100-unit facility, your top-line revenue takes an immediate hit because you aren't collecting those resident fees anymore. But your bottom-line profitability actually improves.
Because you instantly eliminate the operating expenses.
Right. You drop the burdensome lease payments to the landlord, and more importantly, the massive labor costs required to staff a half-empty building.
They're shrinking the top line to grow the margins, which means the portfolio they kept is theoretically a much leaner, more efficient machine, and the margin details really seem to validate that.
Oh, absolutely.
Adjusted EBITDA actually rose 4.3% to $122.1 million. And the metric that stands out the most here is their labor expense. They brought labor costs down to 45.2% of revenue compared to 46.1% last year.
A 90 basis point improvement in labor margins is a monumental shift for a capital-intensive, high-headcount business like senior care. I mean, the macro environment for healthcare labor over the last few years has been incredibly toxic.
Right. Massive nursing shortages, rampant burnout.
Yeah, and operators being forced to rely on exorbitantly expensive temporary agency staffing just to meet the state-mandated care ratios. So Brookdale managing to compress that labor cost percentage means their operational focus at the community level is really tightening.
They are managing scheduling better and relying a lot less on premium agency labor.
Exactly.
And we are seeing that operational discipline bleed into their pricing metrics, too. Consolidated RevPAR surged 8.2% to $5,497. I assume a lot of that is pure pricing power, given that RevPAR, revenue per occupied room, jumped 5.2%.
Yeah, they are successfully charging existing residents more money to cover the inflationary environment, and the segment breakdown of that pricing power is actually fascinating.
Break that down for us.
So in their assisted living and memory care division, which is their largest segment and inherently requires more intensive, higher acuity care, RevPAR jumped 8.1% to $5,711.
Okay, what about the lower acuity stuff?
Over in independent living, RevPAR rose 4.9%.
Mm-hmm.
And then there are continuing care retirement communities, those massive sprawling campuses that offer everything from independent apartments all the way to full skilled nursing saw RevPAR increase 6.9%.
So they are successfully pushing rate increases across every single tier of care. They are squeezing significantly more yield out of the smaller footprint they chose to keep. But we have to address the elephant in the room here. You can raise prices on your current residents all day long, but in this industry, pricing power is just the premium fuel. Occupancy is the actual engine of the business model.
Yeah, you cannot run the car on fumes indefinitely, no matter how high octane they are.
Exactly. And management admitted occupancy is recovering slower than expected, which really drove that post-earnings stock drop. So what is the actual occupancy reality right now?
Consolidated occupancy sits at 82.4%. Now, that is a 230 basis point improvement year over year, which, sounds respectable in a vacuum. But when you look at the internal mix of the portfolio, it is heavily bifurcated. You have a massive barbell effect happening across the remaining communities. On one side, they have 99 communities operating at over 95% occupancy.
Those buildings are essentially full. They probably have waiting lists, and they are generating incredible free cash flow.
Exactly. But on the other side of the barbell, they still have 211 communities languishing below 80% occupancy.
That has to be an absolute anchor on their overall margins.
It is. To understand the drag of those 211 communities, you have to look at the fixed versus variable cost structure of a senior living facility.
Right.
The baseline costs of keeping the lights on are immense. The utilities, property taxes, commercial insurance, baseline culinary staff, and the mandatory 24/7 nursing presence, they are essentially identical whether the building is 75% full or 95% full.
Because those fixed costs are so heavy, operating leverage in this sector is highly exponential.
Exactly. Every single incremental move in past that 80% threshold drops almost entirely to the bottom line. Getting those underperforming buildings from 78% to 85% is where the massive earnings potential is hiding.
So the obvious question is, how do they fix the sales funnel for those 211 struggling buildings? Because management made a very notable move recently by bringing in a new chief sales officer, Margaret K. Bell.
Yes.
And they poached her directly from A Place for Mom, which is like the largest digital referral network in the senior care industry.
Bringing in an executive from A Place for Mom is a highly calculated maneuver. You are not just hiring a traditional sales manager who knows how to conduct a nice building tour. You're bringing in someone who has X-ray vision into the exact digital pathways, search algorithms, and referral pipelines that adult children use when they suddenly need to find care for a parent.
Right, because that's usually how this starts, a sudden need.
Exactly.
Yeah.
And she is implementing activity-based sales accountability across the local community teams. Management pointed out on the call that July data already reflects a 30 basis point sequential occupancy bump just from her initial operational changes.
But all the digital marketing and sales tactics in the world won't really matter if the physical product doesn't meet the family's expectations when they finally show up for a tour.
Right, the eye test.
Exactly. Which brings us to the capital expenditure side of the equation. They are doubling their second half CapEx spend specifically to upgrade common spaces. We are looking at a program called First Impressions, targeting 30 projects this year at an average spend of roughly $500,000 to $600,000 per building.
Deploying $500,000 per community is a very precise surgical use of capital. They aren't doing, ground-up rebuilds or adding new residential wings. They're entirely focused on the lobby, the dining room, and the immediate visual touchpoints.
Because the tour-to-move-in conversion rate is the holy grail metric.
It really is. When a prospective resident and their family walk through those front doors, the psychological impact of that first impression usually dictates whether they sign a lease. If the lobby feels dark, clinical, or dated, the family will walk away, regardless of how good the actual medical care is.
Brookdale needs the physical aesthetics of the building to justify those premium 5.2% price hikes they're pushing through. Upgrading the communities you have is one thing, but Brookdale is also using its improved liquidity to orchestrate a much larger fundamental shift in its capital structure.
Yeah, this is huge.
They're moving from being a tenant to being a landlord.
This is arguably the most consequential long-term strategic pivot happening within the company right now. Historically, Brookdale operated a massive portion of its portfolio under triple net leases.
Meaning they didn't own the underlying real estate.
Right, they just ran the operational business inside the building and wrote massive monthly rent checks to healthcare REITs. And under triple net lease, you aren't just paying rent, you're on the hook for the property taxes, the building insurance, and all the structural maintenance.
You're taking on all the headaches of ownership without building a single dollar of equity.
And you are completely exposed to the annual rent escalators built into those lease agreements, which act as a direct siphon on your operating margins. So now they are deploying their cash to actually acquire the real estate they operate in.
We saw two major M&A announcements reflecting this strategy on the call. The first is in Texas. They acquired the 244-unit Brookdale Galleria in Houston for $23.4 million, which management explicitly noted is well below current replacement cost.
Yeah.
But the operational pivot here is what really catches my eye. They are immediately shutting down the skilled nursing wing of that Houston property so they can remodel it into high-end luxury amenities for the residents. Why purposely shut down an entire healthcare revenue stream?
Because skilled nursing has become an incredibly toxic liability in the current operating environment. When you run a skilled nursing wing, you are dealing with immense regulatory scrutiny, state inspections, and razor-thin Medicare and Medicaid reimbursement rates that rarely keep pace with actual inflation.
Wow.
And more importantly, it requires highly specialized, incredibly expensive clinical staff registered nurses and therapists just to meet state mandates. By shutting down that skilled nursing wing and replacing it with luxury amenities, like a high-end bistro or a modern fitness center, Brookdale is fundamentally altering the risk profile of the asset.
They're shedding a high liability, heavily regulated, low margin medical model and pivoting toward a private pay, hospitality-driven model that carries significantly higher margins.
Exactly. They are abandoning the hospital business to focus on the country club business.
And they are doing this at scale. The second major announcement was an agreement to acquire 17 communities that they currently lease. That is 735 units for $157 million. That breaks down to about $214,000 per unit, and the deal closes in Q4.
The financial impact of that specific deal is immediate. The moment that transaction closes, those massive monthly lease payments they were sending to a landlord just vanish. That cash outflow is instantly converted into owned EBITDA on Brookdale's balance sheet.
You are permanently eliminating that specific rent exposure and capturing the full margin of those 17 buildings.
Right.
But executing acquisitions like that requires serious capital, which means we have to look at the balance sheet action. They have been aggressively de-risking. They refinanced all of their remaining 2027 debt, pushing their next major maturity wall all the way out to 2028. Total liquidity sits at a very healthy $565.8 million.
Yeah, that's a solid position.
And they reduced their annualized leverage to 8.4x. Now, 8.4x is still heavily levered, but considering this was a company operating with leverage well above 11x not that long ago, the trajectory is clear. They are explicitly targeting sub-6x leverage by 2028.
Pushing that maturity wall to 2028 is a massive defensive maneuver. It gives management a 4-year runway to execute these portfolio optimizations and occupancy turnarounds without the immediate threat of refinancing debt in a high-interest rate environment.
Okay, so the balance sheet is fortified, they're buying real estate, shedding bad leases, and making the lobbies look like luxury hotels. Management is clearly pulling the right financial levers.
Yeah, they are.
But for you as a retail investor, you need to weigh those structural long-term improvements against the immediate operational risks that triggered the stock sell-off in the first place. I want to push back on the bull case for a moment. Talk to me about the immediate operational red flags management called out specifically, the move-out volatility and the rising non-labor costs. Because the engine might be getting a tune-up, but there are still some very concerning noises under the hood.
Well, those operational realities are exactly why institutional traders dump the stock after hours. Let's look at the move-out volatility first. Management specifically noted that while gross move-ins were strong, they were entirely offset by a wave of unexpected health-related move-outs.
Which is tough.
We have to remember the human element of this business model. These aren't widgets sitting in a warehouse. These are people in their late 80s and 90s. When a resident experiences a sudden medical event like a severe stroke or a rapid cognitive decline, they suddenly require a level of 247 specialized care that a standard assisted living or independent living facility is simply not licensed to provide.
The family is forced to move them out immediately. It is the ultimate uncontrollable variable. You can have the best digital marketing funnel in the world, but you cannot forecast human biology on a spreadsheet.
Exactly. And when those health-related move-outs happen in unpredictable clusters, it wipes out all of your hard-earned occupancy gains for the quarter.
Right.
And while they are battling that move-out volatility, they are simultaneously fighting elevated costs that have absolutely nothing to do with staffing. Even though they successfully compress their labor expense, they are getting hammered by sticky inflation on the non-labor side of the ledger.
They called out elevated costs in basic property repairs, ongoing maintenance, surging property and casualty insurance premiums, and an uptick in bad debt from residents who can no longer afford the aggressive annual rent escalators.
Yeah, those are stubborn expenses that eat directly into operating margins, regardless of how well Margaret K. Bell's sales team performs.
So, if you are looking at the near-term picture, you have a revenue miss, a slower-than-modeled occupancy recovery, unpredictable move-outs, and sticky inflation eating into margins. It is very easy to see why the market got spooked. But to counter that near-term noise, we have to look at the macroeconomic tailwinds, because the demographic wave approaching this sector is simply undeniable.
It is the ultimate structural advantage for the entire senior housing industry. It's the silver tsunami. The demographic math is set in stone. The United States population aged 80 and older is projected to grow by 5.3% annually, every single year, straight through 2028.
We are looking at millions of baby boomers aging directly into the specific demographic window that requires the exact services Brookdale provides.
Exactly. Demand is mathematically guaranteed to skyrocket. But what makes this setup so compelling for an existing operator is what is happening on the supply side.
Right. Talk about the supply constraint.
So while demand is surging 5.3% annually, new senior housing supply is virtually frozen. Industry projections show new inventory growing at a mere 0.5% per year over that exact same period.
Why is it frozen, though?
To understand why, you have to look at the commercial real estate lending environment. The rapid interest rate hikes over the last few years severely impacted regional banks. And those regional banks are the primary engines that fund the $30 million to $50 million construction loans required to build a new senior living facility.
So the money just isn't there.
Right now, those banks are pulling back lending to preserve their own capital. When you combine tight lending standards with elevated costs for raw materials and construction labor, new development projects simply do not underwrite profitably.
So nobody's is building new supply. You have demand growing at 5.3% and supply crawling at 0.5%. That creates a massive structural imbalance that guarantees immense pricing power and sustained occupancy gains for the existing operators who are already in the ground.
Yeah, they just have to survive the current inflationary environment to capture it. That supply-demand mode is exactly why Brookdale is so focused on protecting its balance sheet and upgrading its existing properties now. When that demographic wave fully hits, they want to own the real estate and capture the entirety of the margin rather than handing it over to a REIT landlord.
Which brings us back to what Brookdale is actually becoming as a company. As you digest all these numbers and strategic pivots, I want you to really ponder the evolving definition of senior living itself. Think about that newly acquired Houston property. The fact that they are actively shutting down a skilled nursing wing to build luxury amenities highlights a massive industry-wide shift.
It really does.
Operators are increasingly abandoning the high-liability, heavily regulated medical-heavy models. Instead, they are pivoting hard toward hospitality-driven, high-margin lifestyle real estate. It is a fundamental re-rating of what this sector actually does. They aren't trying to operate hospitals anymore. They're trying to operate high-end cruise ships on land.
And that strategic transition moving away from a heavily scrutinized healthcare valuation multiple and toward a much more lucrative hospitality real estate multiple is exactly what management is trying to orchestrate with these portfolio dispositions and lease buyouts.
A smaller, leaner footprint, but a drastically more profitable one. They really are cutting off an arm to make the remaining body run faster. But as we established, pricing power is just the fuel. Occupancy is the actual engine. You cannot run a luxury car on fumes forever, no matter how beautiful the newly renovated lobby looks. Management has to get people in the door and push past that 80% occupancy hurdle to unlock the real earnings power. Make sure you follow the show for daily, no fluff earnings coverage just like this. We will see you on the next deep dive.